intangible items are things that you can't touch. Okay, a physical asset such as equipment, I can touch it, I can see it, I can, do something with it with my hands, but intangible assets don't have those qualities. Okay, they are intangible in nature. I cannot touch them. So this would be something like a copyright or a trademark or a patent or goodwill. These are all examples of intangible assets. Our rules with intangible assets: if the intangible asset has a limited life of some type, then we're going to treat them similar to how we did with our fixed assets and depreciation. But because it's an intangible asset, we don't want to call it depreciation. We leave that to mean how we allocate cost out over the life of fixed assets or property, plant, and equipment. For intangible assets, we're going to call that something different. We're going to call that amortization. It's similar in theory to depreciation and done much the same way, but we call it amortization. But we only amortize those intangible assets that have a limited life. So, for instance, patents are given with 20-year legal lives, but sometimes their useful life is less than that. Let's say you purchased a patent that was already existing and only had 5 years left. Well, then you're going to amortize that over either its useful life or its legal life. For a patent, for instance, 20-year life if it was a full patent. Whichever one is shorter, though. Okay, so for that example, we would amortize it over the 5 years, not 20 years. It looks similar to straight line depreciation. So let's say that you had a patent and it cost you $90,000 to develop this patent. Or let's say you didn't develop it. Let's say that you purchased an existing patent and the cost to you was $90,000. And let's say that patent has a life left of the 5 years that we talked about before. So that means that we're going to amortize $18,000 per year. If, however, this had been something that we developed and it cost me $90,000, and so then we had the 20 years and it was the same as the useful life now, then the difference there would be obviously just the number. And that's going to be $4,500 per year. Okay, so again, it's very similar to straight line depreciation. If we needed a partial year, then we're going to take, again, a pro rata portion. So if that $4,500 was for a full year, but we only had it for half of the year, you can divide it in half. You only had it for 2 months, you take 2/12. Same thing we looked at before with straight line. Regardless, here's how your entry looks. It looks similar to depreciation, but again, different term. We're using amortization now. So we've got amortization expense. Shortcut this. And let's say it was that, what was it, 19,000 I think up top? Or 18. I'm going to get my numbers mixed up and confuse you. 18. Hang on. Let's erase. So that $18,000 goes to amortization expense. Unlike what we've done with our fixed assets, we are not going to decrease or create, sorry, not decrease, we are not going to increase an accumulated account. For fixed assets, we have accumulated depreciation. There is no account called accumulated amortization. So now it differs. Now what happens is we take this directly out of the asset account itself. So if this was for a patent, we would actually decrease the patent account. Intangible assets are not held at their historical cost, because we are going to take this amortization out of these accounts. So you see their current carrying value on the face of the financial statement. There's no accumulated account that you subtract to get something like, again, a book value. So now we have taken it already directly out of the assets. You can immediately tell the remaining value to that account. So for any, again, intangible asset with a limited life, we'll do something similar to straight line depreciation, and we'll make an entry similar to this. If it wasn't a patent, it was a different type of intangible asset with limited life, we would list that intangible asset and decrease the account for the amount of the amortization for the year. if for some reason you had additional costs of existing intangible assets, like this patent. Let's say that someone challenged the patent and you had to take it to court and you had a lawsuit on your hands and you successfully defended your patent. All of those fees that were related to that court case, you'd add those up and you would add that to the cost of this patent. What's that going to do to your amortization, though? It's going to change how much you amortize going forward. So you'll have to take those additional costs and amortize them over the remaining life of your intangible asset and add that into your amortization expense, because you're going to add that to the cost of the patent, which again then needs to be amortized for the remaining life. Okay, you can do that all in one lump, or you could do it separately. Let's say that for our example up here, this original example of $90,000, 5 years, okay, and let's say that you had to take this to court, you successfully defended it, and the court money cost you, I don't know, let's say $10,000. We'll keep it nice and easy. But let's say that it's been 3 years that you've owned the patent, so we only had 2 years left on the useful life. Okay, well, you can take that extra $10,000 and you can just divide it by 2. So for the next 2 years, you're going to add an additional $5,000 to that amortization expense. Or you could redo your entire calculation. If you did that, what we're going to do is we're going to take that patent amount. You'll have to figure out how much is left in there. Well, you originally had $90,000, but you've taken away 3 years worth of amortization so far. So you started with the $90,000, you subtracted $18,000 the first year, $18,000 the second year, $18,000 the third year. So what's left in the patent account now? Should have $36,000 left in there. Okay, we've got 2 years left, but we just added an additional $10,000 in the patent account. So right now you've got $46,000 in the patent account, and you've got 2 years left to depreciate this. So each year we're going to depreciate $23,000. Again, if you did it separately like I did up top, we had that $10,000, and over 2 years, each year we would have amortized an additional $5,000. Well, if we add that, good grief, sorry guys, if we add that to what we were amortizing each year, you're going to find that that's going to equal $23,000, the new amount. So you can do it 2 different ways, but either way, for the next 2 years, we're going to have amortization expense of $23,000 total, and decrease the patent by that for each of the next 2 years. Now, if you have an intangible asset that, again, does not have a limited life, it has some type of an indefinite life, then it shouldn't be amortized at all. You just carry that cost on your books. You may have a few that you see over time. You test for impairment. So you test to see if the value has changed. And if so, you can write those down. But, again, in general, you've got limited life, you amortize it. Indefinite life, you don't amortize it.